Today, housing affordability crashes. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, ANZ and Corelogic released their housing affordability report last week. And they said that from the end of September 2020 through to the end of March 2022, Australian home values saw an extraordinary upswing. And during that period, the National CoreLogic Home Value Index increased 27.8%, and across the Australian capital cities and broad rest estate regions, increases in the index range from 14.7% across regional Northern Territory areas to 42.4% in regional New South Wales. And the CoreLogic rent values have also seen significant growth, following a small decline at the national level that coincided with the onset of COVID-19. And between August 2020 and March 2022, the CoreLogic Rental Value Index increased 13.8%, with advertised rents now around 13% higher than they were prior to the pandemic. But whilst the upswing in rents and property values have generated increases in wealth and investment returns for many property owners, at least on paper, it has created greater affordability challenges for those who are renting and for those looking to purchase their first home. Of course, this is something that we've been banging on about for some long time, and it's nice to get some further data to confirm that what we've been saying, that households are under pressure here. And so their report provides an update on the latest housing affordability metrics through to March 2022, highlighting the challenges posed by rising rents, particularly in regional Australia, and the higher savings required for a deposit. And many of those metrics are considered relative to March 2020, which was the onset of COVID-19 in Australia. As the Australian economy recovers, with strong increases in employment and inflation, the impact of future interest rate rises is also considered, including how these may shift affordability challenges from saving for a deposit to servicing a mortgage. Now, the suite of metrics included within the ANZ CoreLogic Housing Affordability Report includes 4 key measures to understand housing affordability across each of Australia's housing markets. These are the ratio of dwelling values to household income, the number of years taken to save a 20% deposit, the proportion of income required to service a new mortgage, and the proportion of household income required to service rent. By the way, CoreLogic values rents based on advertised listings, so it's worth noting these rents measure the cost of servicing rent on a new lease, not an existing one. Another challenge of providing useful insights on housing affordability is the lagged income data. Despite monthly information on rents and values from CoreLogic, estimates of detailed household income is not actually readily available. So to overcome that challenge, they use data from the ANU Centre for Social Research and Methods. They provide modelled estimates of household income, adjusted by information from the ABS National Account data. Through this method, the ANZ CoreLogic Housing Affordability Report presents the time list estimate of housing costs relative to income in the market, unless, of course, they look at the DFA data, because we get it monthly. And so they've calculated income growth for the December quarter of 2021, and they've applied it to the estimate income levels for the March quarter of 2022. Historically, affordability measures are revised over time based on revisions in the ABS National Account data. And of course, those revisions may be slightly larger for the March 2022 quarter, given all the moving parts, and of course, an average masks significant difference between households. But anyway, they say at March 2022, the national median dwelling value was an estimated 8.5 times the median annual household income nationally. This is a record high for the series and has increased from 6.8 since the onset of COVID-19 just 2 years prior. And that's an interesting move because it very much reflects the same sort of movement as I saw in my mortgage stress series. The increase in the dwelling value to income ratio was largest across regional Australia, where property prices have risen substantially more than incomes. Between March 2020 and March 2022, the value to household income ratios across combined regional Australia increased from 5.9 to 7.9. That's faster than the increase in the combined capital cities. One of the unique features of the COVID-19 period has been the acceleration of remote work, where ABS survey data indicates more organisations are committed to remote flexible working arrangements beyond the pandemic. While this has created opportunities for remote knowledge workers to consider relatively affordable housing options, it also has likely contributed to price pressures for long-established residents in the regions. For example, median weekly income estimates for March 2022 suggest capital city incomes are around 32.6% higher than incomes in regional Australia. Comparing median capital city Australian incomes to the median dwelling value of the capitals, the value to income ratio is 8.4. But if we compared capital city incomes to regional dwelling values, the ratio is 6. So the comparative capacity to pay and compete for housing on median city earnings is significant. Increased competition for regional housing from relatively high income earners in capital cities is likely to be contributing factors to rising housing costs in the regions. Well, we certainly see that locally here, down near Wollongong, where local prices have gone up considerably thanks to interest from Sydney. And then we'll go on to say, following a brief decline between March and August 2020, rent values have increased substantially. This is due to a combination of stronger rental demand and lower supply. Rental supply was limited in the lead up to the pandemic, while the pandemic created further uncertainty for housing investors. Despite the loss in overseas migration as a result of travel restrictions, rental demand has more recently been spurred by a strong economic and employment recovery, as well as a preference for larger workspaces at home. Moreover, changing migration trends lifted housing demand in traditionally smaller outer suburban and regional rental markets. Now, at the national level, the portion of household income required to service rent on a new lease increased to 30.6%. That's up from 29.8% in December 2021 and 28.5% in the March quarter of 2020. But rental affordability conditions vary markedly between regions. Relatively weak rental market conditions across Sydney and Melbourne, especially across the unit sector through the first year of the pandemic, meant the level of income required to service rent on a new lease has actually fallen in those cities since March 2020. But the portion of income required to service rents hit a record high in Hobart at 34.4% and Adelaide at 31.6% through to March 2022. During the pandemic, rental demand has been lower in Sydney and Melbourne. The portion of income required to service rent on a new lease is now 30.5% for the median dwelling in Sydney and 24.3% in Melbourne. And across the regions, rental affordability has deteriorated more sharply relative to the combined capital cities. The portion of household income required to service rents in March 2022 hit a record high of 34% in regional Australia. That's well above the 28% of income required to service capital city rents. And across the broad regions of Australia, rental serviceability since the start of the pandemic has deteriorated most rapidly across the Richmond Tweed market, which includes popular coastal destinations such as Byron Bay, where the portion of income required to pay median rents on a new lease has increased from 45.2% in March 2020 to 53% at March 2022. And rent-to-income ratios across Australia have generally risen more sharply across lifestyle markets than have traditionally been popular with tree change and sea change migration. Areas with relatively high exposure to overseas holidaymakers and people working on tourism and hospitality saw downward pressure on rents through the pandemic to date. So that's led to an improvement in the affordability metrics in some areas of Sydney and Melbourne, but many of these rental markets recovered strongly through 2021 and early 2022. For example, the number of monthly rent listings in the Melbourne inner markets fell to 10,513 in March 2022 from a peak of 21,222 in November 2020. Interestingly, rental markets with historically high exposure to overseas migration and tourism began this recovery trend well before international travel restrictions were eased. So it's likely these markets will once again see increased demand as overseas tourism and increased migrations return, creating renewed upward pressure on housing costs. The portion of household income required to service new mortgage repayments sat at 41.4% nationally in March 2022. That's well above the decade average of 36.5%. This was the third consecutive increase at the national level, with higher average mortgage rates and property values contributing to the uplift. Affordability metrics on mortgage serviceability have remained below record highs seen in 2008 and below the most recent highs of 2010, as the record low cash rate environment has tempered interest costs even at record price levels. But that said, ANZ expects the cash rate to rise to 2.35% by middle of 2023, which would shift some of the challenges around housing affordability. Namely, housing values are expected to decline as interest costs rise. However, while lower house prices will lower the deposit hurdle, they won't necessarily make housing more affordable. The potential implications of higher rates for mortgage servicing are actually examined, which looks at the different scenarios, assuming an increase in average mortgage rates of 2.25 percentage points and various levels of nominal decline in housing values. In fact, it suggests that in a higher interest rate environment, mortgage serviceability may become more challenging, even as price levels and therefore deposit hurdles decline. And in fact, in a scenario of 2.25% rise in the average mortgage rate, mortgage repayments will be higher under all scenarios except with a 25% price decline. And using the same parameters, the most expensive dwelling markets see substantially higher serviceability costs on new mortgages, even as prices decline, with interest rates rising. For example, in Sydney's Northern Beaches, monthly mortgage repayments would be $970 higher if prices were to fall 15% and the mortgage rate saw a full 2.25% rise. Recent government solutions to housing affordability constraints have focused on low deposit home loans, such as through the First Home Loan Deposit Scheme, which allows eligible applicants to take a mortgage with as little as a 5% deposit without having to pay lender's mortgage insurance. And based on that, a 5% deposit home loan would leave borrowers with notably higher mortgage repayments under the higher interest rate scenarios, except under the fall in prices of 25%. Of course, actual future scenarios may be very different in terms of the eventual peak in mortgage rates, with financial markets currently pricing in a lift in the cash rate to peak closer to 3.5% and the ultimate decline in housing prices. But weighing up high interest costs with lower prices may be a key consideration for first home buyers. And so in turn, it's worth considering that mortgage repayments in these scenarios are not static over the life of the loan, and the interest rate cycle could drive interest costs higher or lower over time. Now, one of the most significant barriers for home ownership in Australia is the upfront costs of first home buyers. This includes the deposit hurdle, where a 20% deposit for the current median dwelling value across Australia was $147,795 in March 2022. Assuming a household income savings rate of 15% per annum, that puts the current time estimated to save a 20% deposit at 11.4 years. Nationally, that's a record high. The median measure of years taken to save a 20% deposit has risen by 2.2 years since March 2020 nationally. Looking at the back series of this metric, which extends to 2001, that's the fastest uplift in the metric over a 2-year period on record. So it highlights the speed at which home values have risen through the current upswing, and in which annual growth rates have been at their highest since the 1980s. Rapid increases in housing values are a particular barrier for first home buyers compared with other home buyers. This is because those who already own property benefit from gains in home equity as dwelling values rise, while aspirational first home buyers do not. Moreover, rising home prices lift the deposit hurdle for first home buyers, especially as housing price increases have outpaced growth in incomes by a substantial margin over time. So unsurprisingly, the region with the longest time required to save a deposit is Sydney, where the estimated time to save is now at a record high of 14.1 years, and the greatest increase in the time needed to save a 20% deposit in the past 2 years across the capital cities was in Hobart, where the time required to save a deposit increased from 7 years at March 2020 to 9.7 years by March 2022. No surprise then that Hobart and Tasmania is where we see some of the highest mortgage stress across the country. So this is another validation of stupidity in the housing sector, driven by ultra-low interest rates, very strong government stimulus, which drove prices higher. Incomes, of course, have not followed, and so households are now up against it. And these servicing metrics give us some further validation of what my mortgage stress data shows, which is more households are under pressure now, and unless there is a very strong uptick in income growth, which frankly I doubt, we're going to see more distress ahead. No surprise also then that the government policy announced on Sunday relating to further incentive for first-time buyers won't solve anything. It'll put more upward pressure on prices and make the affordability situation even worse. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.